Good morning to my 10 subscribers. So the markets have dipped again. The S&P slipped back towards the mid 4600s. It's actually up slightly more now. And the Nasdaq's down roughly around 6% from its highs. You've probably seen the headlines about liquidity tightening and government shutdown. But let's slow down here. This isn't a crash, it's a reset, and a healthy one that's clearing the air before the next leg up. Please note everyone, this is not investment advice. This is just someone giving their opinion on the markets. So when people say liquidity is tightening, here's what they actually mean. Liquidity is just how much cash and credit are flowing through the system. Right now, the US Treasury is draining its cash account, pulling money out of the private sector, while the government sorts out its funding standoff. Meanwhile, the Fed is still running quantitative tightening, letting bonds roll off its balance sheet. That literally puts dollars out of circulation. Furthermore, bank reserves have dropped another 180 billion in the past 8 weeks alone, which is the fastest pace since 2022. The results? Fewer reserves, less leverage, and a bit less speculative fuel in the system. And once inflation data softens further, the Fed's next step is the opposite, quantitative easing, or QE, which adds liquidity back into the market. That's when they start buying bonds again, injecting fresh dollars into the system. When QE comes back, liquidity expands fast, and that's historically when risk assets rally. And while that's happening, the broader policy backdrop remains pro-growth. The administration pushes investment, infrastructure, semiconductors, clean energy, and AI, all bullish for long-term productivity in the US. And Yellen's been pretty clear that they want financial stability, not market stress, and she's been calling for an end to this government shutdown, which will hopefully come soon. It's the longest one so far. Even whilst all this shutdown noise is going on, no one in DC really wants lasting damage to investor confidence in the US. Further to that, the tone towards crypto and innovation is shifting, or at least it has done. It's more about regulation over restriction now. For example, the SEC approved the first spot Solana ETF and dropped its appeal in the Ripple case, a clear signal of a lighter touch. Now let's look at the actual economy. So services cover 70% of the US GDP. The ISM Services PMI report is a monthly survey where they interview services companies in the US and ask for their opinion, and give them a list of questions and gather that and then consolidate it. They give this report every month. And you can see now that it's actually coming into expansion territory at 52.5. Basically anything above 50 means the economy is growing. This is all free, guys, and you'll be able to read this if you ever want. You can see business activity picking up there. New orders at 56, that's very high. Further to this, the Atlanta Fed GDP now is tracking 2.8% real growth for Q4, basically unchanged from Q3. So what we can say here is that consumer confidence is stable and we're not seeing necessarily a slowdown here. So here's actually where it gets interesting. The forward PE ratio, which is the price divided by expected next year earnings, tells us what investors are willing to pay for future profits. When it's high, expectations are stretched. When it cools, opportunities start to appear. Strip out Tesla and the Mag 7 now trade at 29 times forward PE, which is the lowest since April 2024. To be honest, another 5 or 10% lower and the valuations get really attractive here. So just to summarize, the US economy is still expanding, policy is pro-growth, liquidity is about to turn positive again, and valuations are cooling. And if the market wants to drop another 5 or 10%, thank you, because I don't believe this is the end of the bull market. I think this is the reset before the liftoff.